Welcome, and you are listening to the Financial Survival Network. And if things are working right, you're actually watching the Financial Survival Network as well. And hey, it is December 17th, 2018. Hard to believe. Year is almost Kaputski in less than 2 weeks. As always, we implore you to be a part of the show. Write us. KL@kerrylutz.com. Well, article today, and we've got John Rubino of Dollar Collapse with us.
Hey, Kerry. Holidays.
Yeah.
Year's almost over.
Happy holidays. Merry Christmas. Happy satanic rituals. And Happy New Year as well. Yeah. We probably might not make it together next Monday because it will be the official day of Christmas, year of our Lord, whatever. Doesn't really apply to me, but in any event, hey, read an article today. There's 1,000+ hedge funds in the United States, and there's like about 100 of them or more that are in trouble, which comes as no surprise to you and I, right?
Yeah, well, the hedge fund story is interesting systemically, but it's also interesting, in particular about hedge funds. Basically, what happened was over the past decade or so, hedge funds got hot. It was a cool concept, especially from money managers' point of view, because you get paid more if you're running a hedge fund. You take a little off the top and then you get a cut of the profits, unlike, say, a mutual fund manager who just gets paid according to the amount of assets under management. So everybody wants to run hedge funds. So they created a lot of new hedge funds, but they didn't create a commensurate number of new great money managers, right? They just took existing guys and put them in this new format that charges more and has to return more. And it hasn't worked out for them for a couple of reasons. One is that they came online just as we were starting to inflate the everything bubble. The Fed was creating huge amounts of new currency and tossing it out there, and that money flowed into financial assets and kind of made them all go up at the same rate at the same time. So if you're a hedge fund running some kind of black box algorithm that separates the winners from the losers based on historical data, your method of investing stopped working, right? Because everything's going up at a pretty much uniform rate, which means the best strategy is just buy an S&P 500 ETF.
And lever up and just keep levering. And hey, let's not forget, these hedge funds, it's just another fad. At one time it was mutual funds, another time it was closed-end funds, another time open-end funds, money market accounts. This is nothing new for Wall Street. They're always looking for the gimmick du jour to make you think that they're going to be able to pull a rabbit out of the hat. I guess a lot like Donald Trump.
Yeah. Well, if we haven't learned the lesson by now that it's impossible to beat the market consistently, or almost impossible, a handful of super geniuses do it, and the vast majority of money managers otherwise don't really do it consistently over long periods of time. So with the hedge fund industry, that's pretty much what has happened. And here's kind of the sad part from their point of view. They were reduced in a lot of cases to trend following because the only way to make money was just to buy what was going up, right? So now the biggest hedge fund positions are the FANG stocks, which is that's the sector that's been going down most dramatically lately. So you're seeing a lot of hedge funds report horrendous numbers.
Leverage
especially
up,
when they need to beat the market.
Yeah, leverage up, leverage down. They forgot, it's Isaac Newton, right? It's what goes up must come down. And really, when you think about it, the idea that somehow they could be free from all the rules, the formal rules of working at a mutual fund, and that this was somehow going to give you a higher rate of return, kind of absurd on its face, really anti-logical. And the only way they were able to do it is because they have the ability to unlimited leverage any investment. So an investment that would otherwise provide 10% could provide hundreds of percent just by levering up.
Well, if you're in the top 5%, let's say, of money managers, giving you more freedom works because you can use that freedom to short some things and go long other things and pick up on some exotic strategies that nobody's heard of before and design artificial intelligence to help. You can do all that stuff and generate alpha. In other words, excess return over the risk-free rate or the rate of the index that you're competing with.
Very true.
But you can't just take any old money manager, put them in that kind of a payment structure and expect them to do better than they did when they were running a plain vanilla long only mutual fund, right? Because they're not unnaturally gifted money managers. They're just regular smart guys who happen to be managing money at this point in their lives. And so that's kind of what we did. We tossed a lot of guys in there who, even in a reasonably good market for generating alpha, wouldn't have done especially well. And now they're in a really bad market when even superstar hedge fund managers are getting crushed. And so they don't know what they're doing. They're folding, they're dying like flies. And that's kind of to be expected. We tried this new idea, it didn't work. So now in a relatively free market, you shift out of the idea that didn't work and go back to the tried and true. But in the meantime, we're going to see a lot of big names either fold or scale way back because they're not succeeding. A good high-profile example of this is David Einhorn at Greenlight Capital, who is still a pretty young guy, but who had a huge run. He was considered the next Warren Buffett. He was an absolute superstar who just didn't lose money. He had winning years every year. But lately, a couple of years ago, he decided that the FANG stocks were overvalued and started shorting them and some others. And it didn't work. They kept on going up and up and up. And he lost money for a couple of years in a row. Now he's seeing big redemptions, which is what happens when you're promising huge returns. And not only don't you generate huge returns, but you lose money. You lose a lot of your clients' capital, and they pull out.
Yeah, eventually they figure it out, right?
They figure out that whatever you were doing is no longer working. And so they want to go somewhere where whatever is being done is working. And the problem now is that really nothing is working. Everything went up together, and now just about everything is going down together. And so it's not clear if you're a hedge fund manager, what you do. If your old black box algorithm didn't work, but you want to stay in business, you need to try something else. But your old system was the thing that you built your career on, so what do you do now? And that's the problem with a lot of these guys. They're in a situation that, from their point of view, is kind of unwinnable because the market is inherently unpredictable now. And that's the way markets get at peaks. If you go back to 2007 and look at what the stock markets did then, they were incredibly volatile. They went up and up and up for a while, and then they started going down big and up big and down big, and there was no rhyme or reason to it, no way to predict it from one day to the next. And the reason for that is because buy the dip was colliding with sell the rip. And there were people who had come to believe that selling into strength was the right thing to do. And the people who had come to believe that buying into weakness, which had worked for a really long time, was still the right thing to do. So you get these huge moves up and down when everybody piles in at either extreme because their experience or their intuition has told them it's the right thing to do in that moment. Now that usually precedes a big crash in the stock market because the huge run that had happened previously led to a lot of overvalued stocks with a lot of air pockets under them. So you got to get rid of those air pockets with big drops, right? And so you get something like 2008, 2009 in the U.S. stock market when the big indexes went down by 30, 40, 50%. We could see the same thing again. It doesn't necessarily have to happen now. I'm not predicting a 40% drop in stocks in 2019. But historically, you get stuff like that after what we're getting right now. So it's something to watch out for sure.
And, it kind of feels like a rerun of 2008 8 and 9, where, hey, look, I lived on the East Coast, Northeast then, right by Greenwich, Connecticut. And
did you go to a lot of funerals?
well, I don't know. There was a lot of bodies that never got found, so they had to be buried in absentia. But seriously, like, there's all these places in Fairfield, Connecticut, like hedge funds. Like if there was an empty cigar store, a hedge fund opened up there at some point, and then like dozens of them got wiped out due to redemptions and losses. And then, the Fed came to the rescue, John. Everything was fine for the past 10 years, and now it's deja vu all over.
Well, okay, that raises two interesting points. One is that Connecticut's finances, even though they've got all these hedge funds, they're financing yes, even with hedge funds doing well. And now that hedge funds aren't doing well anymore, you got to wonder what's going to happen to Connecticut's unfunded liabilities and net state debt and muni bonds. They become one of the top handful of catalysts going forward for the next financial crisis if they're going to go bankrupt. We'll see. But right now, their finances are terrible. And that's before all these hedge funds close up and stop paying state income taxes to them.
Yeah, and Connecticut's an interesting case. It was the last state in the country to impose a personal income tax. And its growth rate in jobs, economically, everything has been subpar, has been the lowest in the country, all over. And, there's a reason for that. The power to tax is the power to destroy. Connecticut went from a low tax state to a high tax state, and now they're reaping the rewards of it. And then when you see a key industry, look, I think it was Hartford or Aetna moved out of Hartford, Connecticut, sending that city to a near-death default experience. And, this is just another industry that's going to go out. GE had been in Connecticut for generations. They left because the taxes were getting out of hand. And yet somehow the solution for these high-tax states is let's level the playing field. Let's get Florida and Texas and Washington State and Tennessee. Let's get them all to put in confiscatory state income taxes, and then we can all compete, right? Then it'll be fair. And, that is madness, because rather than looking at the genesis of their issues, of their poorly fiscally managed states, and we could get into all that, but we don't need to. But rather than look to the problem, they look to the symptom, and then they get a solution that can't possibly work, and now they're screwed. And it's the same with Illinois. Illinois gets worse and worse every day, John. Illinois is up to $7 billion worth of vendor payments that they owe, not to mention the fact that their state pension is only 40% funded, lowest, I think, in the country, except maybe New Jersey. And there's really no way out of this until there's either a reset or a total revamping of all of these promises. And I just hope that they do it after the next 3.5 years after I'm on Medicare, and I don't have to care about it, right? Being your usual selfish American here, and you're a little less than me till you get Medicare, and it'll be meta who cares,
Well, when the states go, we shouldn't expect national level entitlements to hold up. They're going to have to cut those back somehow, some way, probably by generating lots of inflation and then lying about the cost of living increases on entitlements, right? They'll give us a bump up, but it'll be half of the increase in our cost of living.
Would they do that,
so we'll get squeezed that way.
John, would they do that?
Yeah, they're doing it now. And they'll do it in a big way later. But Kerry, wait, you mentioned a couple of other things that we need to touch on. One is the Fed meeting this week.
Yeah, the raise or not. This is a really big deal, because this is either the final rate increase in the cycle or the first announcement of the end of the rate increases. Quantitative tightening. right?
Yeah. So one or the other. And, Trump is saying, I can't believe they're even considering raising interest rates. And of course, that's totally his point of view. As the president, you never want to see interest rates go up. I get that. But
No.
he also might have a point this time around, because the signs of weakness in the world are multiplying like crazy. These riots in Europe are affecting European growth. Who wants to visit Paris right now? Their tourism revenues have to be plunging.
My son got stuck in a riot. He was there on business. He was like a block or two from the riot. So actually it's the best viewpoint. It's kind of like a sporting event, and he got to see all the yellow vest people. Now it's spread to the UK. They shut down the Westminster Bridge, and is there anything that these governments can do? Let's hop back 1 second. So let's say the Fed doesn't increase rates this week, which is a very real possibility if the market keeps going down. So they don't raise them. What's that going to do for gold? That should be super bullish for gold if they don't raise them. And because then shortly after the first of the year, we're going to start looking at rate cuts. They're going to start doing it. They might hold off for a few months, but rate cuts are on the horizon here. Interest rates, there's a good possibility of peak, John.
Yeah, well, they're either going to peak soon, or they're either going to peak immediately or peak soon. Yeah. And yeah, you would think that would be really good for precious metals, because that relieves them of the uncertainty of how high rates are going to go and how much competition gold and silver are going to get from bank accounts and other forms of cash, right? So if we're going to cap that at 2-ish%, then that adds a lot of certainty for your gold and silver investments. And that's going to come, if it comes this month, that's going to come just before the seasonality kicks in for gold and silver. Usually January is a great month for precious metals regardless. So you're going to get still a still favorable commitment of traders structure, very powerfully favorable seasonality, and then this big macro thing where the Fed has stopped tightening. That would be a big deal. You'd see gold and silver take off probably. And you'd see the mining stocks really take off. Oh, which reminds me, I need to correct something from last week. I misspoke. I said that gold and silver mining stocks were as cheap as they've ever been. Yeah. Relative to gold and silver, and a couple of listeners wrote in to say, no, that's not true. They were cheaper in 2016, which is true. They're cheap, but they're not the cheapest they've ever been. And I was thinking, I focus mostly on the exploration companies, the really junior miners, and some of them are definitely as cheap as they've ever been. They've just been whacked in the last 6 months. Yeah. So my little segment of the gold market gold mining market is definitely dirt cheap. And that's what I was referencing. I shouldn't have said gold stocks in general.
But you were correct, because in terms of like the GDX and the GDXJ, they're not at their bottom. And if you look at the TSX Venture, the Toronto Venture Exchange, it's not quite as low as its bottom. Mickey Fulp and I, if you haven't watched, you should, or listened, should say. Every month we recap markets. We've been doing this, John, for 6-7 years. We're the only ones that I know of that actually go back a month instead of looking ahead a month. And so we actually see these anomalies. Don't forget the gold-silver ratio. Silver, it's at 86 to 1, silver to gold ratio. And we've got crazy stuff with platinum. Platinum is trading like 30%, 33% less than gold. We've got all these things that a few years ago you would have said it's impossible that platinum will trade under gold for long periods of time and be, a third less. It just can't happen. And that palladium could be trading higher than platinum and almost the same price as gold. You would have said, that can't happen. And yet it did. So these anomalous markets, maybe the jack-in-the-box is about to pop out of the box. All of these anomalies are about to reverse themselves. And that would be classic, because you could see gold go way up and silver follow it and go ahead of it. You might see a gold to silver ratio down back in the 70s, 60s, maybe even the low 50s. That's all possible if this thing just suddenly reverses itself. Other things like premiums on numismatic coins are trading the same as bullion coins. You've got premiums on junk silver. Those are those pre-1965 U.S. silver coins. They're trading at next to nothing. Probably war nickels. I haven't checked them lately. I own a bunch of them. Those are the ones made during World War II that were made with silver in lieu of nickel, because nickel was really in demand. We could see the whole commodity cycle here kind of change gears, and all of a sudden. So a lot is riding on that Fed meeting. But in a way, John, this Fed meeting, whatever they do, doesn't matter, because if it's their increase, it's going to be their last. And if it's neutral, don't do anything, then we're not going to be surprised by that either. The only thing that would really be a shock is if they cut it, but that's like extremely unlikely, virtually impossible to change gears that quickly. Even the Fed wouldn't do that, would they?
You wouldn't think so, no. So the most likely action for them this time around is a quarter point increase.
Yeah.
And whatever probabilities are left over would center around them just not raising rates, and saying they might still raise rates, but this time around there's all this stuff going on in the world, and they think they're close enough to the neutral rate that they'll just watch and see. They'll be data dependent going forward. Yeah, that's most likely.
They'll come up with an excuse like the election of Alexandria Ocasio-Cortez would be a reason why they wouldn't be raising rates, right? If socialism is about to sweep the world, we need to sit back here and not damage capitalism anymore. Some ridiculous, excuse or distraction to do what they. Let's say if they don't raise the rates this week, John, that would be a tremendous credibility bash for the Fed, and would set off a near panic in metals prices, I would think. I mean, although you can't tell, maybe they're being manipulated, maybe not. Hey, one thing is for sure, though, the cryptocurrencies, and we wrote our white paper about them. You can just write us for them, kl@kerrylutz.com, or subscribe to the site at Financial Survival Network. You automatically get John and my white paper. We're going to be updating that soon. But, John, they're trading at below 20% of their peak, which some people might think is a buying opportunity, but just like that Dutch tulip farmer in the 1600s after tulip mania had collapsed, thinking, I'm still cultivating my fields because they went up, they were a fortune at one time, they're going to go back up. That's what the Bitcoin people, crypto people remind me of now, and it ain't going to happen.
Yeah, I wouldn't even pretend to understand the dynamic in the cryptocurrency market. It's still interesting. It's from a economic and financial theory standpoint, the rise of cryptocurrencies is fascinating, and it should be should continue to be really interesting going forward, because they've got a lot of action left in them one way or another. Yeah. And it's going to be fun to watch. But I don't have the slightest idea what the intrinsic value of Bitcoin or Ethereum might be. Yeah. And that leaves me without a whole lot to be able to say.
That's like the intrinsic value.
It's interesting, but it's an unfolding story that's completely new.
What's the intrinsic value of an angel on the head of a pin? Yeah. Nobody can judge these things. We have no basis for judging them. All we can do is evaluate their potential future price behavior based upon bubbles that we've seen in the past. We now know you can't not think, John, right? Correct me if I'm wrong, that Bitcoin was not a giant bubble. At this point, you can't not believe that it wasn't a bubble, can you?
Well, okay, if Bitcoins or if cryptos were the dot-coms of this generation, and we can use that model as a guide to what happens in the future for cryptocurrencies, that's useful, and it's fairly predictable then, because the dot-coms collapsed after they got insanely overvalued, and most of them ceased to exist. But the best of them went on to big things. Amazon, for instance, saw its stock just crater, but it went on to dominate the world of retailing. Cisco, Apple, same thing. With a lot of these high-powered tech stocks from back in the day, they're still around and they're still successful and they're still valuable. So it could be that 90% of the cryptos that exist right now fail, leaving 10% that, for whatever reason, are useful and functional enough to have a future going forward, and that they go on to get big and have a big role to play. Yeah. But again, how you pick the wheat from the chaff in this kind of a market, where you don't even have eyeballs or any pseudoscience kind of measurement that you can use.
Yeah, there's no way to measure it. So it's possible that could be. I don't think it's going to happen because those companies actually did produce something of value, but I'll defer judgment because I agree with you. There is no possible way to tell. And right like clockwork too, John, yield curves flatten, employment hits peaks, right? Unemployment hits all-time lows. Or forget about that, but looking at new claims for unemployment insurance, they hit all-time multi-generational lows. And that has always, in the past, been the tip-off that there's a peak. Now, the question is, can Trump pull a rabbit out of his hat? Is there even a rabbit that can be pulled out that can kind of keep this thing going for another 2 years till re-election time? I'm dubious of it, but I've been dubious of Trump from the get-go, even though I said he was going to win. But I've been dubious, and he's never failed to come through in the clutch. But this could be the time when there's just nothing to be done other than buckle your seatbelts and prepare to descend at a rapid rate for that emergency crash landing that everybody's dreading.
Yeah, well, history says that when you've had a long expansion and a huge financial asset bull market, when the instability starts, the volatility spikes, and you start to see negative economic reports coming out, that's the end. And then you have to have the corrective process begin, where bad debt gets wiped out, overvalued financial assets go back to somewhere closer to their intrinsic value. Mm-hmm. Government tax revenues plunge, and they have to increase spending, so deficits surge. All of that stuff is normal after a long expansion. So you would expect that kind of thing to happen in the next couple of years here. One thing that might buy some extra time is if the Fed reversed course immediately, like we were talking about. That's highly unlikely because the bad after effects of something like that would be pretty outrageous. If you started trying to generate inflation aggressively now, when inflation is, even as the government measures it, which is a very flawed measure that understates the actual extent of inflation, it's already bumping up against their target numbers. And you've got unemployment below 4%, even though that's a suspect number, but a lot of other aspects of the labor market imply that it's pretty tight. You've got companies setting up booths at the local jail to try to hire people because they can't get anybody else. They're hiring, high school kids to come in and work in their aerospace company. There's a lot of stuff out there that implies a very tight labor market.
Yeah, the career fair at the Crowbar Hilton.
Yeah. And they're, more importantly, from the point of view of macroeconomics, they're having to raise wages fairly aggressively in some industries in order to attract people. And that kind of wage inflation spooks the Fed big time.
Big time.
So
bigly.
Bigly. Yeah. So if they cut interest rates aggressively right now, they would be doing it knowing that the secondary effects of that action would be pretty serious from their point of view. So you wouldn't expect to see them do it, but that's one thing that could light a new fire under financial asset prices and maybe pull Main Street along, but it's highly unlikely.
That would be of the seismic variety, like I said before, undermine their credibility, create a panic in things of value. Maybe that could be the start of a huge melt-up, John, and maybe it would send the stock market higher I don't know. This is all conjecture on our part. We're going to have to see what happens, but I think it's a pretty safe bet that this will be the last interest rate hike for the foreseeable future and everything that's going to come along with that, because housing is in the tank. You know, there's a lot of sectors in the tank, but the inertia, it's kind of like the battleship, you know, turning around a battleship. It takes time. In any event, make sure you go check out John's work over at dollarcollapse.com. Check out us at financialsurvivalnetwork.com. Sign up for our newsletters. If you're watching us on YouTube, which I hope you are, you'll also find the audio copy of this on YouTube as well. Then you can subscribe, like, and share us. We try to give you level-headed and cohesive, coherent, and unemotional, unbiased impressions of what exactly is going on in these markets. And the Twitter feed's at Kerry Lutz, the Facebook page, Financial Survival Network, and you can find us on iTunes, Financial Survival Network, or Kerry Lutz. Just search in the iTunes store. John, we will catch you next week.
Thanks, Kerry. See ya.
All right.